Hey, welcome back to The Dive. Hyperinflation, macro regime, government issuances, gold, silver, equity markets, junior miners, and commodities that will be performing over the near term. These are the topics that our guest will deep dive into today. He is a portfolio manager at Crescat Capital. Tavi Costa is joining us today. But before we bring you today's interview, if you could do me a quick favor and like and subscribe to our channel, that would be awesome. Hey, Tavi, welcome back to The Dive.
Hi, Cassandra. Thanks for having me again.
Yeah, thank you so much for joining us again. Okay, so let's dive right into it. Recently, the founder of Twitter, Jack Dorsey, tweeted that we are experiencing hyperinflation. Cathie Wood says he's wrong. It's due to technology deflation. How do you view the whole deflation, hyperinflation argument?
That has been one of the most heated debates that I've ever seen in my career. But I am more on the inflation camp. I don't know. Hyperinflation is a development that happens throughout history. It doesn't happen very quickly. It's something we see in some emerging markets, especially as you see the political environment really losing power and situation of the whole country, along with the instability of a currency and some other issues regarding large amounts of debt. Does that sound familiar with the US? Yes, it does sound familiar, but it takes a long time to play out. And usually being the global reserve currency, I'm not so sure that that's what's playing out right now. I think inflation is not transitory. It's going to continue to build on itself. It will continue to bid up asset prices of tangible assets and hard assets in general. And so for me, that's where the bigger part of this picture should be emphasized towards owning tangible assets and protection of capital. And if hyperinflation happens, well, you're going to benefit from that as well. But I wouldn't necessarily be having that as my base case scenario. I think inflation going forward with some periods of stagflation, of deceleration of growth, and an inflationary environment is much more likely in the following years than the other way around.
Okay, great. Makes sense. All right, so let's talk about your October research letter. You cover several topics and sectors, and you noted that we are currently experiencing a macro regime change. What is a macro regime change? Could you walk us through this?
I think the biggest change that is happening has to do with inflation. We've had a disinflationary environment for the last 30 years, where deceleration of the inflationary forces, not only that, but every inflationary environment that we had in the last 30 years was very cyclical. This time, it is certainly much more sustainable move, and also would say broader in a sense, where it's not only energy, it's not only agricultural, it's not only base metals, it's really almost everything. And some has to do with the supply issues, but supply issues that have been intensified through the pandemic. But something we've seen as far as the declining capex of the production of producers of commodities and natural resource industries for a real long time. And I think this has a lot more to do with that and the complexity of the ESG policies and the complexity of recreating new natural resource projects to fulfill this demand of raw materials that I think is going to be a big deal. We have a fiscal agenda that is very well defined with the green revolution, the infrastructure revamp. There is efforts towards peak inequality, and also this fiscal arms race with China. And so all of this is telling me that there is a big macro shift towards higher cost of capital, not lower, not what we saw in the last decade, where what the last decade allowed businesses to really focus on top line growth because cost of capital was low. So there hasn't been any fundamental analysis and bottom line improvements and margins. That prioritization is going to change, in my opinion. And that's where we're going to see this great rotation out of growth hyped names into historically undervalued, more value stocks. And so this is, natural resources are going to play a big role into this shift. But that's what I mean by the macro regime change.
Okay, so you also mentioned that you see the government flooding the market with issuances of longer maturity instruments at unprecedented levels. What do you think will motivate the government to do this? And what do you think the consequences would look like?
That's such a good point that I think hasn't been really emphasized as well in the markets is this issuance of notes and bonds specifically that is really flooding the market right now. We saw somewhere close to $650 billion worth of notes and bonds being issued just in the last 3 months. And no one is talking about this. The Fed bought somewhere close to 40% of those issues. And so what is going to happen here? In order to understand what's going on, you have to go back to the pandemic crisis and the global financial crisis. There's something that always happens, or has been happening, I would say, in the prior liquidity issues in the markets that we had, which is the government debt increases, but it doesn't flood the market with issuances of long duration bonds. Usually, given the lack of liquidity in the market, the government tends to issue short-term maturity bonds that are much easier to absorb by the market. And so we see T-bills outstanding surge. And we saw that in the global financial crisis. We saw this time again in basically from March to June. And then what we're seeing is a shift or a transition of the debt composition in the government from short-term maturities to longer duration treasuries. So the average maturity of the debt outstanding in the government is now rising. It's somewhere close to 70 months or so. And so that may increase much more. We're just at the beginning of that transition. And what worries me about this is that we're seeing a flood of treasury issuances. The Fed is saying we're not going to be buying this anymore in the next 8 months. And they have been buying, as I said, 35 to 40% in average of those bonds and notes being issued. And at the same time, we're seeing inflation showing signs that are not transitory. We're seeing inflation really developing on itself in a much more sustainable way. And I cannot believe that 10-year yields will be at 1.6, 1.5, 1.7% in the next 8 months to 12 months. I think we're going to see 10-year yields at 2.5% and 3%. So there's going to be some monetary tightening here conditions. Nothing close to what we've seen in the past. It still is one of the most financially repressed environments we've had in history. And you have to think about, as a capital allocator, does copper, agricultural commodities, energy commodities, do they even care if yields go to 2.5% and 3%? My answer is I don't think so. I think it's meaningless to those assets. So we'll continue to see inflation building up. And I think 10-year yields have to rise to even allow the Fed to raise short-term rates. But we got to remember, there is a huge amount of debt imbalance in not only in the government side, but the overall debt in the US, where we're seeing a replacement of the imbalances going away from the private sector into the public sector. And the government is increasing its debt to levels we haven't seen before. So the Fed is really trapped. It can't do much. It's going to have to tighten conditions just enough, as much as they can, to not cause a whole issue on the debt side. But that's not enough to stop the inflation problem. So I think inflation will continue to gain momentum. But we may see 10-year yields go to 2.5% to 3%, in my opinion. From there, I think we're going to hear yield curve control narrative going back very strong, which I think it's gonna dictate the markets in a large way, especially gold.
So you mentioned that gold and silver commodity and equity markets are due for a major bull market resumption. What do you think might spark this?
I think there's a lot of things. I think the acknowledgement that inflation is not transitory could be potentially one of them. I think just the oversold technical environment that we are for gold, silver, and precious metals. I think that the transition of folks really starting to buy into fundamental analysis where miners have never been so cheap. We're talking some companies trading at 3-5 times free cash flow, annual free cash flow, and with growth in free cash flow for the following years. And so those companies are being priced in as they're going to go out of business in the following months or following years. I don't believe in that. the mining space has a lot of the fundamental analysis of looking at cyclicality of the mining industry is pretty clear that we are at the very early stages, in my opinion, of a bull cycle for the space. And how do you see that? You see companies not leveraging up. They're actually paying down debt to amounts that we haven't seen before. We see companies not diluting equities like we've seen in other periods. We have seen companies not doing M&As. We haven't seen any M&As just yet. Companies are gun shy to purchase other projects and acquire other businesses in the space. And so, I think this is quite normal. Usually we see gold, rise to new highs, and then it struggles after that. We saw that in 2008. We saw that in 1978. In 1978, gold reached new highs and went down about 15%. In 2008, gold went to new highs. It stayed there for about 2 to 3 months. And then it declined by about 29% or so, almost 30% during the global financial crisis, to then resume a major bull market all the way to 2011. So in my opinion, the sell-off and correction that we're seeing after hitting new highs in August of 2020 is absolutely normal. And the fact that the whole media, financial media, is calling this as gold and silver and precious metals being a dead trade, it just gives you even more conviction that the sentiment is so negative that it's time to be allocating capital towards this. So I couldn't be more bullish in the space right now.
Mm-hmm. So we're a small cap platform, so we have to ask, where do you see the junior miners in the precious metals industry at the moment? Would it make sense to go long the major producers at this stage?
I think the entire industry is going to benefit from this. However, it's time, in my opinion, to be taking risk. It's not time to be, obviously, it's always time to be risk prudent. However, as an investor, given the fact that we saw the pullback and you have a high conviction view about where we are in the cycle, you should be taking advantage of this instead. You should be taking advantage of the prices that are so depressed. It almost feels like you owning winning lottery tickets that have not been rewarded by the market. So you break down the entire industry rather than owning the royalties, the producers, and even the developers. We're giving a much higher allocation in explorers. We think there's a depletion of reserves happening in the producers space, and they're going to be looking for new projects that are going to be world-class discoveries in order to replenish their production pipeline. And so we think that it's time to be allocating capital in the exploration space. So we have financed over 90 deals in different parts of the world, which we think are very high quality projects with Quentin Henney, probably one of the best exploration geologists in the space. But those are very small cap names. The entire industry today, you look at the Bloomberg database, about 1,200 companies in the precious metals mining space. 80% of them are below 200 million market cap. So there's a lot of value to be found in that space, and a lot of crap too. So you have to be able to screen that from the geology side. But if you're able of doing that, there's a very I guess a lot of value and growth embedded in a place where you can really navigate that. There's not a lot of smart money being allocated in this part of the industry. And also certainly Crescat has been taken away and I would say lead the way in terms of that in the exploration segment of the precious metals industry. We're very bullish as overall, but we think exploration is the way to go for the following years.
Okay, great. Okay, so lastly, what commodities do you think have the best chance of performing over the near term?
It's going to be silver in my view. And I think there's also a case to be made that we saw lumber prices rise significantly. Then we saw energy prices be the next domino to fall. And then we saw some base metals starting to move, lead, zinc. I think if you put me on the spot of what is the next shoe to drop, it would be probably even agricultural commodities. I think there's a very high likelihood that we may see a food crisis that may cause a fit into this whole 10-year yield rise and 30-year yield rise. And inflation is still, building on itself over time, but now related to food prices in a very big way. And so it would be silver, but also I would say agricultural commodities after a small correction or consolidation, depending on the agricultural commodity you're referring to. But the overall space has had a small correction recently and consolidation pattern. I think we're due for a major run to the upside in both agricultural and silver, but also gold as well.
All right. Well, thank you so much for joining us today and sharing your thoughts with us, Tavi.
Well, thank you very much for having me.
Thanks so much for tuning in today. We'll be back again tomorrow with more great content, so be sure to stay tuned by hitting that subscribe button.